Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray, and I am so thrilled to bring you our guest today. I first learned about the research many years ago on Wall Street. The founder of Gavekal was so well respected on Wall Street. There wasn't one PM portfolio manager at any of the largest, most famous institutions, money managers in the United States that would miss this meeting. They always attended these meetings because the research is so thought-provoking. And I should say, not only in the United States, but of course, around the world, they have clients. Let me now bring in the CEO of Gavekal. This is Louis Gav. Louis, great to be with you today. Thank you so much for your time. And I should say, your father started the firm.
Actually, we started it together. My father started a previous firm called Secogest and Cursor Alliance Cursor Eden that he sold to Alliance. Then he basically retired, and my mom came to me and said, look, having your father in the house is driving me crazy. It's the worst of both worlds. It's having a retired husband is less money and more husband, so get him out the house. And so we started Gavekal together with a third friend of ours called Anatol Kaletsky. So we started this together a little over 20 years ago, and fortunately, we're still going.
Oh my goodness. I did not know that side of the story. Thank you for that.
No, not at all. Pleasure.
So let me have you talk a little bit about the type of research that you do. I think that's kind of really important because it just is so thematic and thought-provoking, things that don't really get published on Wall Street for whatever reason.
Well, look, thanks again for having me, and it's great to catch up. It's been a couple of years, I think, but we're a macro research firm and I think our value added or perhaps our differentiating factor is the fact that we're based in Asia. We're based in Hong Kong and in Beijing. Those are our two main offices. And so perhaps what we like to think, we bring a somewhat different angle, one that is far more Asia-centric at a time when, China has been an extremely important shift in the global economy. And to try to understand what's going on in China today, I think is a key component of figuring out what's happening in the world.
Absolutely. And there's so much to go through on that front. I want to first maybe talk a little bit about, from the macro perspective, the energy crisis that is going on. And that's how you term it, an energy crisis, and also the potential of a financial crisis. So let me have you talk about what that actually means to all of us as we see these sky-high inflation numbers.
Absolutely. Well, I think the first thing we have to acknowledge is that the seeds for the energy crisis were planted much before the current Ukraine invasion. In fact, if you go back just to this last summer, China had to shut down steel mills, shut down naval shipyards, banned Bitcoin because Bitcoin was too energy consuming. So already just this last summer, parts of the world were already running out of energy. And China dealt with this by reopening its coal mines, which is what China typically does. When the price of energy goes up, China sort of goes down the quality and cranks up the pollution, which is an option that a country like China has, but an option that Western countries typically don't, partly because we've constrained ourselves with some pretty harsh ESG rules, pollution rules, and whatever else. And so, it's a little bit like Murphy's Law, right? Whenever you don't want something to happen, it's going to happen. We were coming into this coming summer already with very depleted inventories on US energy, European energy policies that simply didn't make sense, whether in Germany, whether in France. And then, of course, on top of that, you throw today's Russia invasion. Now, granted, I would personally argue that had it not been for Europe's almost suicidal energy policies and for the constraints on basically global energy production, perhaps Russia wouldn't have invaded Ukraine. The fact that basically Putin had the world over a barrel probably emboldened him and led him to this catastrophic decision. But whatever the reason, here we are, and we're setting ourselves up for a very, very tough few years on the energy front.
Yeah, and there's so many ripple effects as well, just even in terms of the balance of power and the potential shift in terms of world currencies like the US dollar. Give us a quick line on that and how this plays out.
Oh, that's a tough one to do a quick line on, but let me just say that I think the decisions that have being taken by the Western world following this Ukraine invasion lead us potentially to the most dramatic shift in the global financial architecture since the depegging of gold.
We're going to pick it up right on that. I know exactly what you're talking about. We'll be right back in a couple seconds. Okay, Louis, having read so many of your recent reports, I think what you're referring to in terms of this major shift that is occurring in the world order is following or the result of freezing Russian assets, correct?
Absolutely. Look, I think the greatest comparative advantage of the Western world by far is the fact that we have a blind justice system, right? You can be white, brown, black, you can be Catholic, Muslim, Jewish, you're going to get the same fair shake in a court of law. And this has been the strength, of course, of our systems. This is why I think for the past 25 years, emerging market investors have continued to accumulate Western assets. This is why Chinese people buy real estate in Toronto or Vancouver. This is why Middle Eastern people buy real estate in London. And what we've just witnessed with the freezing of not only the Russian central bank reserves, but more importantly, I would say the freezing of the Russian oligarchs' assets, is the Western world has just said, everybody gets the rule of property is sacrosanct and everybody gets a fair shake in our courts of laws, except if you're a Russian oligarch. We've just added an exception, and we've done it in a blanket way. Now, what does Roman Abramovich have to do with the Russian invasion of Ukraine? What does Michael Friedman have to do with the Russian invasion of Ukraine? Now, our desires to punish Russia for this crime of invading Ukraine, I think, has led us to commit a big error, because we've basically undermined the very strength of our systems. Because when the Western world says, look, your assets are safe here unless you're a Russian oligarch, if you're a Chinese tycoon, you're bound to think, well, hold on, what do you mean except if you're a Russian oligarch? Because tomorrow, for all I know, Xi Jinping could invade Taiwan. And that's a decision I have no visibility on. That's a decision I have no influence on. But if Xi Jinping decides to invade Taiwan, does that mean that my mansion in Vancouver gets confiscated? If so, that mansion in Vancouver all of a sudden is a whole lot less attractive to me. Because the very reason I bought that Vancouver mansion was that it was my sort of fail-safe money, right? It was my bolt hole. And so by basically making a blanket condemnation of and punishment of Russian oligarchs, I think we've again undermined the very system that has made us so strong. Because if you look at the past, really since the Asian crisis, we've lived in a very odd world where emerging markets, because they were always worried about another crisis, would always look to maintain an undervalued currency and run trade surpluses and accumulate Western assets, mostly US treasuries, with those trade surpluses. And this would create a sort of safety mattress in case anything bad happened. Now, we've just told them, well, the safety mattress on which you're losing 5% real per year, the safety mattress, we have the right to grab it whenever we don't like what you're doing. And again, if you're China with $1.5 trillion in treasuries, if you're Saudi Arabia, if you're India, if you're any one of these countries, you might think, well, hold on, that wasn't the deal. And so this sort of odd world in which we've been living in, where basically consumption in rich countries was subsidized by people in poor countries through undervalued exchange rates and constant recycling of current account surpluses into the Western world. This may be coming to an end right in front of our eyes, because there really is no more reason to do it if from one day to the next your assets can be confiscated. Right. And that would mean rising emerging market currencies, because there's no more point in running current account deficits. And I think that's what you're seeing right now. Basically, if you look at the past few months, you've seen the Brazilian real go through the roof. You've seen the Mexican peso go through the roof. You've seen Chinese bond yields fall under US bond yields for the first time in modern history. You're seeing a profound shift, something that you perhaps wouldn't have expected as a direct consequence of what is perhaps one of the biggest crises in emerging markets, Russia invading Ukraine. But what most people are focusing on is how the dollar is strong against the euro and the yen. Meanwhile, it's being very weak against emerging market currencies.
It's hard to believe, though, that such a shift could take place when you think that people wouldn't still want U.S. treasuries as a safe haven play. But, it's interesting when you list all those countries that are saying, wait a second, look, like whether it's Saudi Arabia, China, like massive economies with lots of wealth, you can start to see a world in which perhaps the U.S. dollar doesn't dominate world currencies. We're going to pick it up right after the break. Louis, we just left off and I said, it's hard to believe that people wouldn't want U.S. treasuries. And when I say people, I mean largest economies in the world. But, you also write, and this did shock everybody, and if it didn't, it should, that Saudi Arabia floated the idea of pricing their oil in renminbi. And why should that be so shocking to people?
It should be shocking because we've lived in a world that has been all basically US dollar centric. You wanted to buy commodities, you had to save US dollars to buy them, which meant you had to sell stuff to the US first. But this is changing right in front of our eyes. Russia is now basically telling China, hey, you can buy my commodities in renminbi. It's telling India, hey, you can buy my commodities in rupees. And so, indeed, I think if you're Saudi Arabia, it puts you in a tough bind because China and India are obviously the world's, amongst the world's largest energy importers, and it's the world's fastest growing markets if you're an energy exporter. So, do you want to be cut off from those markets? And if you don't, maybe you have to match Russia's terms.
Yeah.
And so, we are perhaps witnessing a profound shift in the global financial architecture.
And Louis, I want to pick it up as well, because what's interesting in terms of this dynamic shift that's occurring is you write that having the cheapest cost of energy is so key and critical in terms of which economies are going to win. And if China can strike a deal with Russia in terms of a very cheap cost of energy and priced in renminbi, where does that lead China from an economic perspective versus the United States?
Look, Catherine, that's a great point. Economic activity is mostly energy transformed. And, with that in mind, I think people underestimate that the extent to which the greatest macro development of the past 10 years was the US shale revolution. The fact that the US had all of a sudden an absolute collapse in its cost of energy that brought it much cheaper than anybody else. Natural gas falling from $10 to $2.50 meant that not only inflation was low in the US, not only did the US trade balance improve dramatically, but the US dollar was strong on the back of this, all of which allowed the Fed to stay easier for longer. This is now, of course, over. In the past 2 years, the Fed has moved from producing 13 million barrels per day to 11.8 million barrels per day. The economic benefits of the US shale revolution are now over, begging the question of who over the next 10 years is going to be the cheapest energy producer. From basically 2000 to 2011, China was the world's cheapest energy producer because it produced most of its electricity with its cheap domestic and highly polluting coal. Then China decided to freeze coal because it was just too disgusting. And then the US became the world's cheapest energy producer. So who's going to be the cheap energy producer or consumer, I should say, over the next decade? I think before the Ukraine war, there was a case that it might be Europe. Thanks to Nord Stream 2, Europe had perhaps the possibility to not only tap into Russian natural gas, but to tap into that natural gas and have it priced in euros, which basically would have meant for Europe that it was almost free. You get the natural gas from Russia for euros, and then Russia recycles these euros into your own domestic bonds. So Europe was actually looking not so bad up until 2 months ago. Europe now looks an absolute disaster. And instead, Europe's loss is China's gain. All of a sudden, all the energy that was going to go to Europe will now be going to China. China will be buying it at a discount and paying for it in renminbi. So as you think, okay, who gets the cheap cost of energy for the next 10 years? It could well be China, because first, China is now reopening its coal mines, and started to do that last summer. And Chinese coal production has moved from 300 million metric tons to 400 million metric tons. So they're going to have by far the cheapest cost of productivity of electricity, and then on top of that, they're going to get the cheap Russian energy. So in this sort of energy geopolitical world of ours, the balance has just shifted to China.
So what does that mean then from an economic perspective or an investment perspective? And we'll talk a little bit more about that in the next segment. But does it mean then that, because you also talk a little bit about perhaps owning more gold, just given the freezing of assets? I'm kind of jumping a bit, but
no. But I think the first thing it means is if you're BASF or if you're DuPont, you're setting up your next petrochem plant not in Europe, definitely in China, because you know that China will be the place where you get a secure and cheap source of energy for the next 10 years.
Understood. Yeah. Quick break, and then we'll come right back. Louis, we could talk for hours, and I think it would benefit all of our viewers just to understand these different dynamics that really don't get talked a lot about in media or even strategy reports. But we only have about 5 minutes, and I really want to get to what some of these changing shifts and dynamics means for investing, and whether we're in a bear market, what the equity outlook looks like, kind of top down. How do we invest in somewhat of a fragile environment, as you call it?
Well, I think, the starting point for us is always acknowledging that asset prices are driven by the interaction of economic activity and inflation. And, for the past 30 years, we've lived in a broadly disinflationary environment. And this is no longer the case. We are now in a world that is deglobalizing, which is inflationary. We are now in a world with a new Cold War, which is inflationary. We are now in a world where big parts of the world are going to try to de-dollarize their economies, and this is important because you've had, 25 years of accumulated current account deficits of the United States moving abroad and funding working capital, funding these safety measures, most of which could very well come back to the U.S. And further fuel or an inflation rate that's already pretty high. So today, your first acknowledgement has to be, I am no longer in a deflationary boom. I live in an inflationary boom. And in an inflationary boom, bonds and equities are no longer negatively correlated. They're positively correlated. We've seen this for the past 2 years. Bonds no longer do the job that you'd want them to do in a portfolio. So the first thing an investor has to do is to acknowledge that, I've been holding these bonds to cushion my risk for when equity markets go down, and they're not doing that job anymore. And so there's no point in me having these guys in my portfolio. So what do you replace bonds with should be the big question. And the unfortunate answer is there is no easy answer. There is nothing as good as bonds are. In a deflationary world, bonds are so great that I think we've all become a little lazy because we had these bonds always, having our backs. And that job is, it's hard to find anything else to fill that job. I think you have to parcel out whatever you used to have in U.S. Treasuries or in Canadian government bonds, and part of it should be emerging market bonds. If I'm right about the de-dollarization trend, if I'm right about emerging markets no longer needing to run big current account surpluses and letting their currencies go up, as you're seeing today in Mexico, as you're seeing in China, as you're seeing in Brazil, these are the bonds you need to hold today.
You're talking about owning Chinese government bonds, which was a new idea to me.
Absolutely. Most people don't realize this, but Chinese government bonds have actually been the best performing bond market for the past 10 years, for the past 5 years, for the past 3 years, for the past 1 year. It's which makes sense since China is trying to de-dollarize its economy and make the renminbi Asia's new reserve and trade currency. It needs to do that. It needs to offer, I would say, disproportionately high returns on its bonds. And And we're there. We're taping this, I think, on the 12th of April. Yesterday, the 11th of April was
13th. We're the
sorry,
13th.
13th. Sorry. So the 2 days ago, the 11th of April was a historic day where Chinese government bond yields fell below US government bond yields for the first time, which makes sense. You have 8.5% inflation rate in the US. You have 1.5% inflation rate in China. China through COVID did not follow crazy fiscal policies, did not follow crazy monetary policies. They didn't debase their currency in the hope of buying social peace. So this is the bond market you want to own. But so you need to look at your US Treasury position and say, okay, what do I replace it with? I think you replace it with emerging market bonds. I think you replace it with gold. And I think you replace it with energy. And here I'll just finish on a very simple idea, which is that when you look at bear markets, when you look at big bear markets and economic recessions, they are triggered by one of two factors. And those two factors historically are either rising interest rates or rising energy prices. So when you invest, those are always the two big risks that you have, that basically high energy price or high interest rates come and plant a knife in your back. Where is the greater risk today? Is it in interest rates moving far above the nominal growth rate of GDP? Or is it energy prices crushing consumption? To me, it's pretty obvious that it's energy. There is no way central banks can catch up with the runaway rate of nominal GDP.
Okay. Louis, we've got to leave it there. I wish we could keep going, but thank you so much.
Absolutely my pleasure, Catherine. Great to see you.
Thank you. You too.